So we think Bitcoin will make a new high this year. I think the most important advice I can give people is that trying to time the market makes you an enemy of your future performance. We still like the Mag 7 because we're confident of their earnings growth. And so as long as they don't derate, they should actually perform better than the market. But this year, our top sector pick is energy and basic materials.
Tom Lee begins with a powerful but often misunderstood idea. Bitcoin is digital gold, but the people who believe that thesis are not the same people who currently own physical gold. Gold ownership is deeply embedded in older generations and institutional portfolios, while crypto adoption remains far more concentrated among younger investors. That gap matters because it means Bitcoin still has a much higher long-term adoption curve than gold, but the path to that adoption will not be smooth. Before we go on, just a quick reminder, liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support.
Bitcoin is digital gold, but the universe of people that believe that thesis is not the same universe that owns gold. And so crypto still has I think, future adoption curve that's higher than gold because more people own gold than own crypto. But the path to getting that adoption rate higher is going to be very jagged. And I think 2026 will be a really important test because if Bitcoin makes a new all-time high, we know that deleveraging event is behind us. So we think Bitcoin will make a new high this year. Well, it's driven by, I think, the usefulness of crypto increasing. So we know banks, for instance, are recognizing blockchain and the idea of settlement and finality work really well on blockchain. And then a company like Tether, which is a crypto-based bank, is proving that a bank that emerges natively on blockchain is actually better than a traditional bank. For instance, Tether is expected to make almost $20 billion in 2026 earnings. That would make it a top 5 in terms of bank profits. On valuation might be number 2 only to JP Morgan, twice the valuation of Goldman Sachs or Morgan Stanley. Tether only has 300 full-time employees. JP Morgan has 300,000. So by using blockchain, they make almost as much, they make more money than any bank, and they only have less than 1% of the M1 money supply and a tiny balance sheet, and yet it's one of the most profitable banks in the world. You know, Ethereum is the second largest blockchain, and it's, I think, always going to be more volatile than Bitcoin until it becomes similar in size. The crypto world views Ethereum as a price ratio to Bitcoin. So there's this, if you just simply said ETH to BTC, assume Bitcoin is the price denomination of the crypto world. Ethereum's price ratio to Bitcoin is still below where it was in 2021, 4 years ago. And that, compared to 4 years ago, Ethereum is a far superior blockchain because we know tokenization, including dollars are tokenized, is one of the big bets Wall Street's making. I mean, Larry Fink says it's the biggest innovation since double ledger accounting. Vlad at Robinhood wants to tokenize everything. And we already see a lot of effort to tokenize not just dollars, which is stable coins, but credit funds. JP Morgan is launching on Ethereum a money market fund. BlackRock has already tokenized credit funds on Ethereum. So Ethereum is really the blockchain that Wall Street is beginning to use. If Ethereum's price ratio recovers to the 2021 highs and Bitcoin goes to 250, Ethereum would be around 12,000. And Ethereum is around 3,000 today. I think the most important advice I can give people is that trying to time the market makes you an enemy of your future performance. Because a lot of investors always only want to buy at the bottom and they want to sell at the top. But when we look at the stock market, and actually in crypto too, the only people who really make money are those who are investing for the long term. So as much as I'm warning about 2026 and the possibility of a lot of turbulence, they should view the pullback as a chance to buy, not the pullback as a chance to sell and to avoid stocks. I think it's a really important distinction because too many people sell on emotion and then they don't make the second decision to buy back. And then they miss out on all the compounding investing delivers. One of the things that we have to appreciate is that crypto is being adopted by the younger generations. I mean, it is a part of their lives because they are digital natives, and there is really a blurring between what's a service and what's money in the future. It's no different than in 1995 when Bill Gates was on Letterman talking about the internet. David Letterman expressed enormous skepticism of what the internet was because he was the wrong generation to adopt the internet. If Bill Gates was explaining that to a 20-year-old, a 20-year-old instantly understood the future of the internet. And I think that's what's happening with crypto today. I think that I would have a dual-pronged effort. One is there's something called a Lindy effect. I would only buy the cryptos that have been around, so Bitcoin and Ethereum. But the second thing I would focus on is that crypto is the settlement layer. It may be invisible in the future.
Crypto adoption is being driven by digital native generations, Gen Z, millennials, and beyond. For them, the line between money, technology, and services is already blurred. Tom Lee compares today's skepticism toward crypto to the skepticism surrounding the internet in the mid-1990s. When Bill Gates explained the internet to older generations, it sounded confusing and unnecessary. But to younger users, its future was obvious.
We still like the Mag 7 because we're confident of their earnings growth. And so as long as they don't derate, they should actually perform better than the market. But this year, our top sector pick is energy and basic materials. So in early December, we made that our favorite sector ideas. Part of it is a mean reversion trade. Energy and basic materials have underperformed so badly over the last 5 years that if you look at their performance in the last 75 years, it's usually marked a turning point, the level of underperformance. And then I think some of the geopolitical things that are taking place would favor both groups. But I think another thing this year is the ISM is likely to break back above 50, and along with Fed cuts, that means industrials, financials, and small caps. So I like Mag 7, but I think cyclicals could be the more interesting trade this year. I've learned oil prices and energy stocks don't correlate. Part of it is that energy stocks price the future levels of oil prices. And I think that we may see weak oil prices or volatility in the near term, but everything from data centers and this shift away from alternatives is going to be putting upside into the future prices of oil, and that's why energy stocks can outperform. I think in the midst of being reviewed in terms of the durability of their business models in a favorable way. I think the banks have invested so much in tech and into AI that they are really big beneficiaries of that super intelligence coming. And the bank's biggest expense is compensation. So I think banks can reduce their reliance on employees in the future, which means their margins go up and then the variability of their earnings drops. I think they're going to get re-rated more like technology stocks. And when I started in research in the 90s, banks used to always just be 1 times price to book or 10 times earnings. And I think that they should get a market premium multiple. What will lead in the correction are crowded trades, because that's when people have to de-risk. So it makes sense that, the Mag 7 are the large holdings. Will people de-risk? But as you know, when people get nervous, maybe they go into the Mag 7. And so to me, it's possible that the non-US stocks could be the ones where you see correction, because that's where there's a lot of money that's been made. Non-US stocks did far better last year than US. And so if there's trade escalations and uncertain about the global economic outlook, maybe that's where the correction could be greater.
But you said only 10% of the AI stocks will turn out to be a good investment over the next decade. But you still like the sector?
Yes. I think that that's pretty true of any exponential growth sector. For instance, when we look back at the internet, if you looked at a basket of stocks, let's say in 2000, so 25 years ago, I think only 2% of all the universe's stocks actually survived. But the return generated by that 2%, and then let's say you lost money in the other 98%, you still outperformed meaningfully the S&P 500. So I think in the AI sector, a basket of the entire universe of stocks, it may be more than 90% turn out to be poor investments, but the winning investments more than make up for it. Today, companies IPOing are more mature in their later stage. But it does seem like that's changing. I think for the first time, we're seeing companies now more interested in going public, not all through IPOs, some through SPACs. I think that's coupled with the fact that the alternative world, which is venture, private equity, private credit, the investors in those, LPs, limited partners, they haven't really received distribution. So I think that there is an allocation away from alternatives into public markets, and that it's kind of now pushing more things to go into public markets. But you're right, like it's as much as we say that, in the last 12 months, I've seen many publicly traded stocks have big moves. So I think that there's still a lot of opportunities. I think that some of the listeners should think back to Apple, which Apple analysts that cover the stock from its IPO in the 80s insisted Apple was a hardware company, and they couldn't get over the fact for many years that Apple shouldn't trade more than 10 times earnings. And yet they had a services business that was growing. They, of course, had created a whole ecosystem and retention model that really showed Apple was not just a hardware company. But I remembered even in the 2015, 2016, 2017 period, I'd meet with institutions and say Apple's a hardware company. And now, of course, Apple's re-rated completely. I think people look at NVIDIA as a cyclical hardware company, and that's why they're giving it grudgingly a 26 multiple. Whereas NVIDIA, as you know, essentially is a company that has high visibility on future earnings and yet trades at half the multiple of Costco. I think there's a lot of room to re-rate those stocks higher. For instance, in January of last year, Mark Newton kind of warned that there could be a drawdown. It turned out to 20, was way bigger than we expected. But we still wanted people to stay fully invested. And people made their money back by July. I think that like small mid caps have underperformed for so long that even if there is a drawdown, it's not going to interrupt the fact that there could be a 5 or 6 year cycle of small cap outperformance. So I'd still want to own that. Granny isn't going to go up if the market goes down. So I think anyone buying these ETFs should be aware of that, but they are buying the strongest companies linked to the most important themes. So to me, they should hold up better on a drawdown and of course be stronger on a recovery. There's only maybe one central bank that might have bought more than Tether.
Wow. Because that's not talked about very much.
No, it hasn't. But if you look at one way to simply look at it is look at Tether, USDT outstandings, and gold price since July, and they've been highly correlated. But I think a second factor is we did a study in 2018 showing you that investment preferences skip a generation. So baby boomers loved gold. Millennials liked hedge funds. I'm sorry. Baby boomers like gold. Gen X liked hedge funds. But now millennials who are entering their prime working years like what their grandparents liked, which is gold. So I think that there's renewed interest in gold. So those are the two invisible reasons.
So what's the takeaway? Yes, volatility is coming. Yes, 2026 may feel uncomfortable. And yes, corrections can feel like bear markets even when they aren't. But history rewards investors who stay invested, stay diversified, and stay disciplined. Bitcoin, Ethereum, AI, energy, and cyclicals all sit at the intersection of innovation and long-term growth. Pullbacks don't invalidate these themes, they often strengthen them.